Welcome. We are doing financial reporting and analysis. The question is on published financial statement. Published financial statement. We are doing November 2015, question 1. Therefore, let us first read the question, then we go through the additional information, and then we finally answer the question. I repeat, we are doing November 2015, question 1 on financial reporting and analysis. The question is on published financial statement. Therefore, Dora Limited, a quoted company dealing in household goods, has prepared the following trial balance as at that 1st December 2014. Revenue, loan interest paid, purchases, distribution cost, administrative expenses, interim dividends paid, inventory as at 1st January 2014, trade receivables and trade payables, cash and cash equivalents, ordinary shares of shillings 10 each, share premium, general reserve, retained earnings as at 1st January 2014, 4% loan payable, land and buildings, costs we have land is shillings 60 million, accumulated depreciation, plant and equipment, cost, then we have accumulated depreciation, investment property as at 1st January 2014, rental income, proceeds from sale of equipment, then we have additional information. 1. Closing inventory as at 31st December 2014 amounted to shillings 388 million at cost. However, shortly after the year end, some inventory with a cost of shillings 15 million were sold for shillings 8 million. Land and buildings were revalued on 1st January 2014 to shillings 800 million, including land at shillings 100 million. The buildings have a remaining useful life of 40 years. Number 3, the income tax liability in the year was estimated at shillings 20 million. Deferred tax was to be provided at shillings 7 million. Number 4, during the year, the company sold some equipment which had cost shillings 15 million with accumulated depreciation as at 1st January 2014 of shillings 3 million. An item of plant was also estimated to be impaired by shillings 4 million during the year. Number 5, depreciation rates as per the company's policy are as follows. Buildings over the useful life period, plant and equipment 20% reducing balance. The company's accounting policy is to charge a full year's depreciation in the year of an asset's purchase and none in the year of disposal. The company treats depreciation of plant and equipment as a cost of sale, and on land and buildings as an administrative expense. Dora Limited values investment property at fair value. The fair value of the investment property as at 31st December 2014 was shillings 586 million. During the year, the company made a 1-for-3 bonus issue, capitalizing its general reserves. This transaction has not been accounted for. Required. What are you required to do? Prepare in a format suitable for publication the following financial statements for Dollar Limited for the year ended 31st December 2014. A. Income statement. B. Statement of changes in equity. And C. Statement of financial position. Note: Notes to the financial statements are not required. Round your figures to the nearest shillings million. Therefore, we are going now to start with our first requirement of the income statement. But before we do that, we must first go through the additional information, do the workings, so that we can come up with our income statement. We see which items in the additional information are affecting our income statement. Okay. If you look at the additional information number 1, the closing inventory as at that 1st December 2014 amounted to shillings 388 million at cost. However, shortly after the year end, some inventory with a cost of shillings 15 million was sold for shillings 8 million. Therefore, what does that mean? This additional information number 1 is testing your understanding of International Accounting Standard 2. International Accounting Standard 2, or what we call IAS 2, which states that the inventory is measured, or the inventory is always measured at the lower of cost or the net realizable value. Therefore, you have to look at the cost or the net realizable value. Whichever is lower, that is what you take to be the value of your closing inventory. Therefore, what we are going to do in this additional information number 1, we are going to remove this 15 million from 388 million, because 15 million, if you compare, this is the cost. 15 million is the cost, but 8 million is the net realizable value. 8 million is the net realizable value. Therefore, you are going to take 388 million. You deduct this 15 million and you add this 80 million, or what you are saying, you take 388 million, you remove this 15 million, you replace it with 8 million. Let us do that very fast. Therefore, if I come to my working note number 1, where I have the closing inventory, I have said you take the total of the closing inventory, which is 388 million. You deduct that inventory which have issues, that is 15 million. You replace it. You replace that with 8 million. And if you do that, how much are you going to get as the value? How much are you going to get as the value of your closing inventory? 388 minus 15 plus 8, that is 3. You are getting 381 million. And therefore, we are done with that additional information number 1. We go to the additional information number 2. Land and buildings were revalued on 1st January 2014 to shillings 800 million, including land at shillings 100 million. The buildings have a remaining useful life of 40 years. Therefore, what is being tested in this question is your understanding of revaluation and how you calculate the depreciation. Your understanding of revaluation and how you calculate the depreciation. And you can see this is also connected with note additional information number 5, where it says that Depreciation rates as per the company policy are as follows. Buildings over the useful life period. Plant and equipment 20% on reducing balance. You are also told um, the company treats depreciation of plant and equipment as a cost of sale and on land and buildings as an administrative expense. Therefore, when we calculate the depreciation of buildings, we are going to treat it as an administrative expense. Therefore, let us go to our working note number 2 and we calculate the depreciation of building. We are told it was revalued on 1st January 2014, that is at the beginning of the year, to 800 million. That is the total fair value or the revalued amount of buildings including land. Therefore, we are going to deduct the value of land, 100 million, because remember the land is usually not depreciated. And then we divide by the useful life of 40 years to get uh, our depreciation. 800 minus 100, you divide by 40. You are getting 17.5. But remember, you are told notes. Note to the financial statement are not required. Round your figures to the nearest shillings million. Therefore, we are going to round this figure to the nearest shillings million, which you get 18 18 million, 18 million. And remember, this depreciation of building is being treated as an administrative expense. Therefore, I'll come here to my administrative expense. I'll come to my administrative expense and add that 18 million there being the depreciation of building in working note number 2. Then we will calculate the revaluation later. We proceed. Number 3, the income tax liability in the year was estimated at shillings 20 million and deferred tax was to be provided at shillings 7 million. Remember, this is the first time they are providing for deferred tax. Therefore, our total tax expense for that period will be 20 million plus 7 million. 20 million plus 7 million, because the tax expense is usually calculated as the estimated tax. Then you add the increase in deferred tax, because remember the journal entry for deferred tax, if the deferred tax increases, you credit the deferred tax account and you debit the profit and loss account. Therefore, when the deferred tax increases, your tax expense for that period also increases. Therefore, the tax expense is usually calculated as the estimated tax plus the deferred tax. And if there was any over provision or under provision for the previous year tax, if there was any over provision or under provision of previous year's tax, the over provision you the over provision you add it, the over provision you deduct it, no, sorry, the over provision you deducted from your tax expense, and the other provision you added from you to your tax expense. Therefore, in this case, we are just going to calculate our tax expense, Therefore, I can come directly into my income statement where I have the where I have put the tax expense, and you can see it is 20 plus 7. Therefore, this now will be the total of tax expense. That will be the total of tax expense. Then we go to additional information number 4. During the year, the company sold some equipment which had cost shillings 15 million with accumulated depreciation as at 1st January 2014 of shillings 3 million. An item of plant was also estimated to be impaired by shillings 4 million during the year. Therefore, in this case, your understanding of property, plant, and equipment is being tested. How do you dispose property? How do you recognize property, plant, and equipment which have been disposed? Okay. How do you recognize them? Okay. Therefore, in this additional information, during the company sold some equipment which had cost shillings 15 million with accumulated depreciation as at 1st January 2014 of shillings 3 million. An item of plant was also estimated to be impaired by shillings 4 million during the year. And remember, so which item in this additional information, which item are affecting our income statement, because currently we are dealing with income statement, and later on we'll deal with the statement of financial position. Therefore, here you are going to calculate either the gain or the loss on the disposal, either the gain or the loss on the disposal, and you're also going to calculate the depreciation of the remaining plant and equipment. The depreciation of the remaining plant and equipment. Therefore, how do you do that? Let us first calculate the depreciation. Let us first calculate the depreciation. Depreciation is in our working note number 2. We are told the depreciation is 20% on the reducing balance basis. Remember that the reducing balance basis is usually equals to the rate of depreciation you multiply by the book value of the asset being depreciated. The rate of the depreciation you multiply by the book value of the asset being depreciated. And the book value is usually equals to the cost minus the accumulated depreciation. Therefore, we are going to take the cost of plant and equipment. We check that in the financial in the trial balance. The cost of plant and equipment, it is 258, and the accumulated depreciation is 126. That is at the beginning of the year. So we take 258, we minus 126. That is the accumulated depreciation. But remember, there's an asset that we have disposed. There's an equipment that we have disposed in our additional information number 4. We have disposed an equipment which had a cost of 15 million. Therefore, we deduct that one here. We have disposed that equipment of 15 million. And this equipment had an accumulated depreciation of 3 million. Therefore, we deduct 3 million from the accumulated depreciation. Deduct 3 million from the accumulated depreciation. And therefore, we are going to calculate our depreciation on the balance. Therefore, we say 258, we minus 15, then we minus 126. 3. We are getting 120. Then we take 20 multiplied by 20 divided by 100. We get our depreciation is 24 million. That is the depreciation. And the depreciation of plant and equipment is being treated as a cost of sale. Therefore, that depreciation, we are going to put it here as a cost of sale. That is 24 million. And there is also an impairment of plant. In that additional information number 4, there's also the impairment of plant. Where is it? The impairment of plant, which was impaired by 4 million. Impairment, remember, impairment is an expense. Impairment is the deterioration of an asset. An asset being worn out. Yes? Impairment. Impairment is an expense. Therefore, we are going to put this 4 million in the cost of sale because even the depreciation of plant and equipment, we are putting it at the cost of sale. Therefore, we add our impairment there. The impairment of plant, that is 4 million. Then then we calculate either the gain or the loss on disposal. Remember, the gain or the loss on disposal is usually equals to the sales proceed you minus the sales proceed you minus the book value of the asset being disposed. The sale proceed you minus either the book value or the fair value of the asset being disposed. Therefore, we go to our income statement where we have loss on disposal. We take the proceed on disposal of equipment, that is in the trial balance. Proceed from sale of equipment were 7 million. Therefore, we take proceed, that is 7 million. We deduct the book value of that equipment. The equipment had a cost of 15 million. If you take 15 million, you deduct 3 million, you are going to get the book value. Therefore, 7 million, you deduct the balance here. That is when you are going to get the loss on disposal. That's 15 minus 3, 7 minus 12. Yeah, you're getting a loss of 5 million. A loss of 5 million. I think as per the income statement is concerned, we are done with this additional information number 4 and also the additional information number 5. Therefore, we go to the additional information number 6. Dora Limited values investment property at fair value. The fair value of the investment property as at 31st December 2014 was shillings 586 million. Therefore, here you are just supposed to calculate the gain or the loss in fair value. Remember, under the International Accounting Standard 40, the changes in fair value of investment property, the changes in fair value of an investment property are usually taken or adjusted in the statement of profit or loss. Any change in the fair, therefore we can calculate the change in fair value. So the fair value at the end of the year, that is at that 1st December 2014, was 586 million. What was the fair value at the beginning of the year? That information is in the trial balance. The investment property as at that 1st January 2014 was 548. Therefore, we come here, investment property. The fair value at that 1st December 2014 is 586. We put 586 here, 586, and at the beginning of the year, in the from the trial balance, we have seen it is 548. Therefore, if you take the difference now will be the increase or decrease in the fair value. 586 minus 548, you get an increase of 38 million. Therefore, that is a profit which will be taken into our income statement, an increase of 38 million. And we are done with that additional information number 6. Additional information number 7, does it affect our income statement? Let us see. During the year, the company made a 1-for-3 bonus issue capitalizing its general reserves. This transaction has not been accounted for. Therefore, this we are going to account it for in when we will be doing our income statement. When we will be doing our sorry, not income statement, statement of financial position and statement of changes in equity. Remember, in number C, number B, we are told to do the statement of changes in equity. That's when we are going to calculate this one. Therefore, let us finish up with our working notes so that we can finish up with our income statement. Working note number 1, we have opening inventory that is in the trial balance. How much is the opening inventory? The opening inventory is 444 million. Opening inventory is 444 million. We add our purchases. How much is our purchases from the trial balance? It is 1669, 1669, 1669. If we do that, our closing inventory had calculated, depreciation we had calculated, impairment of plant, that one was given. If you do that, we are going to get our cost of sale. That is 44 plus 1669 plus 381 plus 24 plus 4 plus 1669. This closing inventory is going to be deducted. Remember, you usually deduct the closing inventory in your cost of sale. Therefore, 44 plus 1669 minus 381 plus 24 plus 4. You're getting 1760. You're getting 1760 as your cost of sale. 1760 as your cost of sale. Then we go to investment property. That one is done. Administrative expense. We look at the reported figure of administrative expense in our trial balance. How much was administrative expense? The administrative expense was 345. Therefore, I'll come here and add 345 plus depreciation of building. 345 plus 18 million. We are getting 363 as our total administrative expense. Then finally, Finally, we go to our finance cost. Finance cost. Finance cost, that is the interest which was paid during the year, or anything else which can be classified as a finance cost. Therefore, we go to finance cost. And the finance cost is just the interest on 4% loan. The interest on 4% loan. How much is the 4% loan? The 4% loan payable in 2024, that is this year now, was 150 million. 150 million is the 4% loan. Therefore, I'll come here and say the interest will be 4%, that is 4 over 100. We multiply by 150 million. We get the interest, or what we are calling the finance cost. 4 out of 100 multiplied by 150, we are getting 6 million. 6 million. But remember, in the trial balance, you are also told, in the trial balance, you are told loan interest paid, you are told that the loan interest paid is 3 million. The loan interest paid, is 3 million. Therefore, it therefore means that this company did not pay the total of finance cost. Therefore, there's an accrued interest. There's an accrued interest. The total interest is 6 million. The interest paid on loan is 3 million, which means therefore that the 3 million, the balance, is the accrued interest on the 4% loan. This one we are going to take it to the statement of financial position. Therefore, now we are done with our finance cost. Therefore, there was no any adjustment about revenue. We just take revenue from the trial balance. Revenue is 2648. 2648. Our cost of sale 1760. Our cost of sale is 1760. So if you deduct 1760 from 2648 minus 1760, you are getting 888 as your gross profit. 888 as your gross profit. Then you add other incomes. You add other incomes. There's rental income in the trial balance. This is the rental income of 48 million. This is the rental income of 48 million. Then there is the loss on disposal of equipment. That is 15 million minus 3, you're getting 12 million. So 7 million minus the 12 million, you're getting a loss on disposal of 5 million. Then increase in fair value of the investment property, or we can call it gain in fair value. Let's call it gain in fair value. Gain in fair value of investment property, working note number 3, which is that 8 million. that 8 million. Therefore, if we do this, we get the total gross income. We get the total gross income. How much are we going to get? 888 plus 48 minus 5 plus that 8. I'm getting 969. Then we go to distribution, to our expenses. We start with the distribution cost. We go to our expenses. We start with the distribution cost, which is how much? How much is the distribution cost from the trial balance? We go and check it out. Distribution cost is 514. So we deduct 514. Administrative expenses, we have done our working number 4, 363, 363, 363. Our finance cost, we have done our working 5, which we got 6 million. 6 million. If we take this income, we deduct these expenses, then we are going to get our profit. We are going to get our profit before tax, which is how much? 969 minus 514 minus 363 minus 6. We are getting 86 million as our profit before tax. Then we have our tax expense. That one we had discussed it as we were doing the additional information number 3, that is 20 million plus 7. So we deduct, the total is 27. We deduct 27 million. Therefore, after deducting that, we get our profit after tax. 86 minus 27, I'm getting 59. I'm getting 59 as our profit after tax. And now we are done with the income statement. We go to the second requirement where we were required to do the statement of changes in equity. The statement of changes in equity. Here we have it. The statement of changes in equity, we have ordinary shares. How much was the ordinary shares at 1st January 2014? Then we have the share premium, general reserve, revaluation reserve, and the retained earnings. We check how much was the ordinary shares at 1st January 2014 from the trial balance. The ordinary shares were 100 million. The share premium is 244. General reserve is 570. And the retained earnings is 349. Ordinary share we have seen that was 100. Share premium 244. General reserve 570 million. And the retained earnings 349. There were no revaluation reserve at the beginning of the year. Then the profit for the year, we have seen it is 59 million from the income statement. The profit that we have just calculated in the income statement, 59 million. 59 million. Then the interim dividends which were paid. How much was the interim dividend paid during the year? The interim dividend paid was 6 million. And from the additional information, you can see there was no proposal of the final dividend. Remember, interim dividends are dividends which are paid at the middle of the year. They are dividends which are paid at the middle of the year. And the final dividend is declared at the end of the year. It is declared or paid at the end of the year. Therefore, I'll come here and deduct the interim dividend of 6 million of 6 million. Then there was revaluation of land and buildings in the additional information. Number 2, land and building were revalued on 1st January 2014 to shillings 800 million, including land at shillings 100 million. The building have a remaining useful life of 40 years. Now we are just concerned with the revaluation because the depreciation we have taken care of it in the income statement. Remember, the revaluation gain is usually equals to the fair value or the revalued amount, the amount at which the asset has been revalued, you minus the book value of the asset at that time of revaluation. The revaluation here took place at 1st January 2014. Therefore, what was the book value at 1st January 2014 of these land and buildings? You can check it in the trial balance. Land and buildings had a cost of 380 million and accumulated depreciation of 64 million. Therefore, the book value at 1st January 2014 or at the beginning of the year during revaluation will be 380 million minus 64 million. Therefore, we come here, that's the book value. Therefore, to get our revaluation gain or the revaluation reserve, we're going to take this 800 million, then we deduct the book value of land and building, where the book value will be equals to 380 million, you deduct 64 million. Let me show you practically what I'm saying. The revaluation of land and building, you take the fair value or the revalued amount of the asset, which is 800 million. Then you deduct the book value, where the book value is 380 million minus 64 million. And if you do that, you are going to get your revaluation as 800 minus into bracket 380 minus 64. I'm getting 484. 484 as the 484 as the revaluation gain or the revaluation reserve. Then we go to the issue of additional shares. Let me here call this one bonus issue. Bonus issue. In your additional information, number 7, you are told that during the year, the company made a 1-for-3 bonus issue, capitalizing it as general reserve. This transaction has not been accounted for. Therefore, this means that if a shareholder had 1 share, he was getting 3 more shares in form of bonus. The shareholder will be given 3 shares per share that they held in the company as bonus. And those shares, they were reducing the general reserve or utilizing the general reserve. Therefore, they were reducing the general reserve and increasing the shares. Therefore, how many shares were in the company? How many shares were held by the shareholder in the company uh, at in the company when the bonus were being issued? We just check that information in the trial balance. The, the, then the ordinary shares were 100 of 10 each. Therefore, it therefore means that there were 100 million. That is the value of the shares. Then you divide by 10 to get the number of shares. Therefore, 100, the value of shares, you divide by 10, uh, you multiply by 3 because this now is the number of shares. You multiply by 3 to get the new number of shares. And these bonus shares which were issued at a par value of 10 because even the ordinary shares were at a par value of 10. Therefore, you multiply by 10. You multiply that one by 10, which you're going to get 300. Or you could just say that since they were 100 as the value of shares, and the new shares, the new shares, that is the bonus shares being issued, are equal in value, uh, are equal in value, they are equal in value to the ordinary shares. You could just say that therefore the additional shares were 300, and then these shares were coming from the general reserve. Therefore, you come to general reserve and you deduct 300. Come to the general reserve and deduct 300. Is there any other changes? There's no any other change. There was no change in the share premium. So we can get the totals of our equity here. That is 400. This will be 244. This will be 270. This will be 484. And this one 349 plus 59 minus 6. I'm getting 402. Therefore, we are done with our statement of changes in equity. We are done with our statement of changes in equity. And now we finally go to the final requirement, which was, what was the final requirement? The final requirement was a statement of financial position. A statement of financial position. We usually start with the non-current asset. From the trial balance, the non-current asset that we had were land and buildings, plant and equipment, and investment property. Usually, in the published account, these are usually combined together and called property, plant, and equipment. Property, plant, and equipment. Therefore, I'm just going to get the total figure here, which is now going to represent the property, plant, and equipment. We start with land and building. Land and building in our working note number 6. We have the fair value of land and land. The fair value of land and building at 1st January 2014 was 8 million. That is the the revalued amount of the asset at 1st January 2014, or which is usually called the fair value. Then we deduct the depreciation for the year. In our working note number 2, we got 18 million. We deduct 18 million. Therefore, we'll get the book value at that 1st December 2014, 800 minus 18 million. I'm getting 782. I'm getting 782. Then we go to plant and equipment. We had plant and equipment at cost. At cost, it was 358. It was no, sorry, 258. It was 258. Then there was the disposal of equipment. The cost of the equipment was 15 million. Then there's the accumulated depreciation. The accumulated depreciation was 1.6 million. You deduct the accumulated depreciation of the equipment which was disposed. That is 3 million. 3. You get your accumulated depreciation as 123 million. 123 million. Then the depreciation for the year in our working note number 2 was 24 million. Remember, it was 24 million. Where is working note number 2? Yeah, the depreciation was 24 million. And then we have the impairment loss from your additional information. Impairment loss from your additional information number 4, you are told an item of plant was also estimated to be impaired by shillings 4 million during the year. Therefore, you also deduct the impairment loss of 4 million. And if you do that, you are going to get your book value at that 1st December 2014, 258 minus 15 minus 123 minus 24 minus 4. You are getting it as 92. And we are done with that. So we come to our statement of financial position as at that 1st December 2014. Land and buildings. Land and building, we have got 782. 782. Then we have plant and equipment. We have got 92. Then we have investment property. The investment property, it is 586. Or from your additional information number 7, during the year, number 6, dollar limited value investment property at fair value. The fair value of investment property as at that 1st December 2014 was shillings 586 million. 586 million. 586 million. Therefore, if we get this figure, $782 plus 92 plus 586, I'm getting 1460. 1460. Therefore, this now represent the total value of property, plant, and equipment. Property, plant, and equipment. Then we go to the current asset. We go to the current asset. We start with the inventory. We had done our working. The closing inventory, how much is the closing inventory? The closing inventory is 381 million. 381 million. Then trade receivables, that one we get it from the trial balance. Trade receivables and trade payable. Trade receivables is 545 million. The trade receivables is 545 million. Then we go to the cash and cash equivalents. From the trial balance, cash and cash equivalent. Cash and cash equivalent is 28 million. Cash and cash equivalent is 28 million. We add this together to get our total current assets. Our total current asset, we are going to put it on this side. $381 plus 545 plus 28, I'm getting 954. 954 plus 1460, getting 2414 as the total asset. $2414 as the total asset. Then we go to equity. Equity has no a lot of working because we have done the statement of changes in equity. Therefore, we are going to take these figures from the statement of changes in equity. Ordinary shares, 400 million. Share premium, 244. General reserve, 270. Revaluation reserve, 484. 484. And the retained earnings, 402. 402. Therefore, the total of your equity becomes 400 plus 244 plus 270 plus 484 plus 402. You are getting 1800. 1800. Then you go to your long-term liability. Your long-term liability, you start with a 4% loan. You start with a 4% loan. How much was the 4% loan? It was 150. 150. Then the deferred tax, that was 7 million. Therefore, the total of your non-current liability, or what we call long-term liability, is 157 million. 157 157 million. Then finally we go to the current liabilities. And current liabilities, we have trade payables. We go to the current liabilities. We have the trade payables. How much is the trade payables from the trial balance? The trade payables is 434 million. For that 4 million. Then we go to the tax payable. The estimated tax is 20 million. That is the current tax payable because the deferred tax is 7 million. The estimated tax is 20 million. And finally, the accrued interest on 4% loan. Accrued interest on 4% loan. It is how much? The accrued interest is 3 million. The accrued interest is 3 million. If you add all this together, you get if you add all of this one together, you get your total current asset as 344 plus 20 plus 3. You're getting 457. 457. Then we take 457, we add 157, and we add 1800 to get our total equity and liabilities. Our total equity and liabilities. Our total equity and liabilities. That is 457 plus 157 plus 1800. 457 plus 157 plus 1800. And we are getting 24, 24, 14, or what you call 2 billion for 14 billion. And as you can see, our equity and liabilities have balanced with our asset. Therefore, our statement of financial position has balanced. You can ask any question you have in regard to this question in the comment section. Thank you very much. I'll see you in the next video.